Let's talk about what the Santa Clara County single-family home market is doing right now and what that means for both buyers and sellers. If you're looking for data on condos or townhomes or nearby counties, reach out and I will get those to you. But for simplicity purposes, today we're gonna focus on single-family homes. As of April 3rd, we were 1,244 active single-family listings here in Santa Clara County, 671 homes pending, and that's an absorption rate of 53.9%, which puts us in that balanced market. Again, 60% and above seller's market, right around 30% buyer's market. That absorption rate matters because it gives us a clean read on supply versus demand. And a balanced market is important because it usually means opportunity exists on both sides, but only when expectations and strategy are realistic. Now, this is still a very different setup from when both buyers and sellers were dealing with about 2 years ago. Now, if you go back to early April of 2024, there were 798 active listings and 715 pendings, which created a nearly 90% absorption rate. Now, that was a much more intense seller-favored environment where buyers had fewer choices and less time to think. Now, in early April of 2025, inventory had increased to 1,211 pendings, and we were at 715. An absorption rate had eased to 58.8%. Now in early 2026, inventory sits at 1,244 pendings and at 671 absorption rate of 53.9%. So year over year, inventory is up 2.7%. Pending activity is actually down 5.8%, and the market is still giving buyers more choices with less frenzy than it did in prior spring markets. At the same time, 671 pendings is still a meaningful number, so sellers should not mistake balanced for dead. Now, the short-term trend tells an important story as well. Over the last 4 weeks, active inventory moved from 1,109 on March 13th to 1,267 on March 27th, before easing slightly to 1,244 on April 3rd. Pending sales were 680 on March 13th, 678 on March 27th, and 671 on April 3rd. The market actually started off pretty strong this spring. Inventory was building, buyers were still engaging, and pending activity held in a relatively tight range, even as more homes came to the market. Then we had a new layer of hesitation that entered the picture. The Iran conflict brought daily market volatility, rising oil price concerns, and a visible hit to consumer sentiment, especially among middle and higher income households, which matters a lot here in a place like Silicon Valley. That kind of day-to-day uncertainty tends to make both buyers and sellers pause, not necessarily because their long-term plans changed, but because big financial decisions feel harder when the headlines and stock market are bouncing around every day. And on top of that, we also hit a calendar stretch that often slows people down anyway. Easter holiday at the beginning of April and the tax deadline on the 15th right behind it. Now, both those two things often create a short-term pause in housing decisions and activity. People travel, spend time with family, meet with accountants, review taxes, and mentally put major housing decisions on hold for about a week or two. So if activity feels a little softer in this immediate window, that does not automatically mean the market is fundamentally breaking down. Some of it is simply seasonal and situational timing. Now for buyers, that means this may be a window where there's a little bit more room to breathe, ask questions, and negotiate thoughtfully, especially if other buyers are hesitating because of volatility or distractions. But it doesn't mean the best homes will stop attracting attention. For sellers, it means this is not the time to panic if traffic or urgency feels a little slower over a holiday and tax stretch. There's still a real demand in the market, but buyers may be taking a beat before making decisions. And that means presentation, pricing, and patience matter. Now, some buyers hear all of this and immediately ask, should I wait? Maybe they're thinking about affordability, rates, or whether 2027 will be better. But here's the reality. Affordability has always been an issue here, especially in Silicon Valley, so that part is not new. And if you're waiting on the Fed to bail you out, the current outlook still points to just one rate cut in 2026 and one in 2027. Not some dramatic drop that suddenly changes the whole game. Rates are only part of the story here in our valley. You also have to watch the stock market, especially tech stocks, because buyer confidence here is tied closely to stock compensation, vested shares, and overall tech wealth. When the tech market feels strong, buyers tend to feel stronger. And when it feels shaky, some buyers pause, even if housing supply itself has not changed that much. That affects sellers too. In Silicon Valley, a seller is not just competing against mortgage rates, they are competing against buyer confidence, stock market psychology, and how liquid or cautious local tech buyers feel in that moment. And how about new construction? With limited space available, it has clearly not solved the housing shortage here, and long-term supply strengths are still part of why Silicon Valley stays expensive. There's additional commentary that inventory could begin to open up as pandemic-era low-rate loans and ARM periods age out closer to 2027, but that is still more of a developing opportunity than a guarantee. So if buyers are waiting for a huge flood of inventory or sellers are fearing one, the data does not really support that at this juncture. For active buyers, I think this creates two particular options if you're not finding the home you want right now. Number one, step up and buy at a higher price because the neighborhood you really want is not likely to come down just for you. Number two, expand your search radius and stay realistic about what your money buys today. Now for sellers, the takeaway is different, but just as important. If you have a good home in a desirable area, this can still be a very good opportunity to sell, but only if you respect today's buyer psychology and price the property in line with the current market instead of yesterday's headlines. Now, the bottom line, this is a better market for educated buyers than the market we saw in 2024 because there is more inventory, less pressure, and more room for strategy. And for sellers, it's still a good market, but one where strategy, pricing, and condition and marketing matter more than they did when absorption rates were at that 90% level. Now, whether you're buying or selling, don't make your decision based on hope, fear, or headlines. Make it based on your timing, your goals, and what the data is actually telling you. So whether you're buying or selling, don't make your decision based on hope, fear, or headlines. Make it based on your timing, your goals, and what the data is actually telling you. Thanks, friends. I'll see you on the next video.